Retail traders lose money because they treat futures like a lottery ticket. Wall Street professionals treat futures like a cold, calculated exercise in risk management. Today, I am going to show you exactly how the big players, the hedge funds, the institutional desks, and the market makers approach these markets step by step. We need to start with a fundamental truth. You are not betting on a stock price. You are trading a derivative contract that tracks an underlying index or commodity. That means leverage is baked into the DNA of every single tick. Most amateurs blow up because they view leverage as a way to get rich. Professionals view leverage as a way to free up capital for other trades. It is a tool for efficiency, not a shortcut to a yacht. Let us look at the structure of a professional desk. Everything begins with the order flow. You are looking at candlesticks and moving averages, but the pros are looking at the footprint. They want to see where the volume is trading. In 2012, the shift toward electronic order books changed everything. Before that, you relied on gut instinct in the pit. Now you rely on the level 2 and time and sales data. The first step in a pro trader's day is identifying the liquidity zones. These are not just support and resistance lines you draw on a whim. These are levels where large institutional orders are waiting to be filled. They use a tool called the volume profile. Unlike a standard bar chart, the volume profile plots volume at specific price levels rather than over time. If you see a high volume node, that is where the big institutions have built their positions. If you see a low volume node, that is a price vacuum where the market will move quickly to find fair value. Step 2 is understanding the auction process. The market is a continuous double auction. Buyers are trying to find a price high enough to sell, and sellers are trying to find a price low enough to buy. Professionals never fight the auction. If the market is moving up, they look for reasons to buy, not reasons to sell. They identify the point of control. This is the price level with the highest traded volume in a given session. This is the magnetic center of the market. Everything revolves around this point. Step 3 is risk allocation. This is the part that separates the pros from the gamblers. A professional trader never risks more than 1% of their account on a single trade. If you have a $100,000 account, your absolute maximum loss is $1,000. That is not a suggestion. It is a survival requirement. They use what is called the expectancy ratio. If they win 60% of the time and their average winner is 2 times larger than their average loser, they are going to print money. It is not about being right. It is about the math of the long run. Step 4 is the use of market delta. When you look at a chart, you see a green candle. That means the close was higher than the open. But a pro wants to know the aggression behind that candle. Was it aggressive buying or passive absorption? If you see a large volume of selling hitting the bid, but the price stops dropping, that is called absorption. The pros realize that a large buyer is sitting there, soaking up all the supply. That is a massive signal to go long. When the selling dries up, the price will rocket upward because there is no more supply left. Step 5 is the correlation trade. You cannot trade the S&P 500 futures, known as the ES, in a vacuum. You have to watch the bonds, the dollar index, and the VIX. In 2020, during the COVID crash, the correlation between the ES and the VIX was nearly perfect. When the volatility index spikes, your long positions in the ES are almost certainly doomed. Pros monitor a basket of intermarket assets to confirm their thesis. If the ES is hitting a new high, but the Nasdaq is lagging and the bonds are tanking, the pros will stay out. Divergence is the best early warning system in the world. Step 6 is the execution strategy. Most retail traders use market orders. That is a death sentence. You are paying the spread every single time you click buy or sell. Pros almost exclusively use limit orders. They add liquidity to the market, which often earns them rebates from the exchange. In a high-frequency environment, those fractions of a cent add up to millions of dollars in annual savings. They wait for the price to come to them. They do not chase the market. If the price does not hit their limit, they do not trade. Discipline is the only bridge between a strategy and a profit. Step 7 is the exit. This is where the amateurs fail the hardest. They move their stop losses further away when a trade goes against them, hoping for a turnaround. This is called the hope trade, and it is the fastest way to zero. A pro sets their stop loss before they even click buy. Once the trade is live, the stop loss becomes a sacred line. If the thesis is invalidated, they take the loss immediately. There is no emotion, there is no ego. The market does not know you exist, and it certainly does not care about your bank account. Step 8 is the post-market review. Every single professional trader maintains a trade log. They track the time of day, the instrument, the setup, and the outcome. They look for patterns in their own mistakes. Did I get emotional? Did I overtrade when the volatility was low? Did I trade outside of my high probability zones? You cannot improve what you do not measure. The most successful traders I know spend more time reviewing their old trades than they do actually taking new ones. Let us look at a case study. Think about the flash crash of 2010. Prices plummeted because automated algorithms triggered a cascade of sell orders. Retail investors panicked and sold at the bottom. The pros, however, looked at the order flow. They saw that the selling was not driven by fundamental news, but by a liquidity gap. They bought into the panic. They identified that the selling volume was massive, but the underlying value of the assets had not changed. They held for the inevitable bounce. This is the mean reversion strategy. They bet that prices will return to the average after an extreme event. You might be asking, how do I get started with this level of depth? You do not need a Bloomberg terminal that costs thousands of dollars a month. You need high-quality data. You need a platform that provides tick-level order flow, such as Sierra Chart, Quantower, or Bookmap. These tools allow you to see the market depth and the footprint. You can see the actual orders sitting on the books. This is the difference between watching a video of a football game and actually being on the field. Another critical component is the concept of time-based versus volume-based charts. Retail traders live and die by the 5-minute candle. Pros ignore time. Time is arbitrary. The market does not care if it is 10 o'clock a.m. or 2 p.m. The market only cares about volume. That is why pros use volume charts or range bars. A range bar only forms once a certain amount of price movement has occurred. This filters out the noise of slow trading sessions where nothing is happening. It allows you to focus on the moments when the pros are actually entering and exiting. Let us talk about the iceberg order. This is a classic Wall Street tactic. If a hedge fund wants to buy 10,000 contracts of the ES, they cannot just put in a massive buy order. It would move the market against them instantly. Instead, they use an iceberg order. They show a small number of contracts to the market, perhaps 50, and keep the rest hidden. As the 50 are bought, the order refreshes. You see a constant stream of volume at one price, but the price does not move. This is an institutional footprint. If you learn to spot the iceberg, you can piggyback on their massive trade. Consider the role of the news. Amateurs try to trade the news. They try to guess what the Fed is going to say or how the jobs report will land. This is pure gambling. The market almost always moves in the opposite direction of the initial headlines because the move was already priced in by the big players. Pros trade the price reaction after the news. They wait for the dust to settle. They wait for the market to reveal its hand. If the news is bad but the market refuses to drop, that is a bullish signal. If the news is good but the market refuses to rise, that is a bearish signal. Price is the truth. Everything else is just noise. You also need to understand the value area. This is the range where 70% of the day's volume occurs. This is the most efficient part of the market. Pros look to trade when the price is outside of the value area, moving back toward it. They look for the value area high and the value area low. These act as magnets. If the market is trading significantly above the value area, it is overextended. The professionals are looking to short it back into the range. If it is trading below, they are looking to buy it back in. Now, let us get real about the psychology. You are competing against computers that can execute thousands of orders in a microsecond. You are competing against teams of PhDs in physics and mathematics. You are not going to beat them by being faster. You beat them by being more selective. The pro trader is a sniper. They wait for the perfect setup, they execute, and then they walk away. The biggest mistake is thinking that you need to be in the market all day long. The market is not an ATM, it is a minefield. You walk through it only when you have a map and a reason to be there. What happens if you lose your edge? Every trader goes through a slump. A professional acknowledges the slump and reduces their position size. They do not increase size to make it back. That is the path to insolvency. They reduce size, focus on the fundamentals, and rebuild their confidence one trade at a time. They treat trading like a professional sport. You need rest, you need a healthy brain, and you need to keep your ego in check. Wall Street pros are not magicians. They are not psychics. They are merely systems-oriented thinkers. They rely on probability, math, and the mechanical reality of order flow. They remove the "I think" and replace it with "the data shows." They do not care if they win or lose on a single trade, because they know that if they follow their process for 10,000 trades, the math dictates they will end up on top. If you want to trade like a pro, you must stop looking at the lines on your chart as shapes and start seeing them as human beings. Every candle represents a person or an institution losing money or making money. The price is just a reflection of their collective panic, greed, and indifference. When you understand the struggle behind every price movement, you gain an edge that no indicator can give you. The market is the ultimate mirror. It shows you exactly who you are. It reveals your impatience, your greed, your fear, and your lack of discipline. The question is not whether you can outsmart the market. The question is whether you can outsmart yourself. Are you willing to kill your ego? Are you willing to treat this with the same seriousness as a surgeon treats an operation? The wealth is there for those who respect the process, but for those who treat it as a shortcut, the market will eventually take everything you have. The difference is entirely up to you.